Today, folks, we're going to talk about these two Canadian dividend behemoths. Like, these are the mega caps of this damn country, posting earnings, absolutely crushing it. No damn surprise when it comes to Royal Bank. Not only that, but increasing the dividend as well. Stock's not up that much, and obviously a lot of it's probably priced in. Like, I mean, there's a lot of anticipation around 20% plus growth going on. We'll dive into it, though. But Telus, on the other spectrum, this dividend behemoth, a lot of investors have been keeping their eye on here because it has dropped off even more into the latter half of the year here, now almost yielding 9%. And did they cut the dividend? No, but they did announce that they are not increasing it into the future, and they're talking about potential growth that they're going to focus on and kind of repaying down some of the debt. But that did get investors excited enough to pop the stock up 3% today, and I want to talk about all of this and more. So if you're on a path to financial independence, if you love nerding out with stocks, consider hitting that subscribe button, folks, because this is my financial Super Bowl. We are in the midst of Canadian bank earnings, and it isn't an exciting time to really be cost averaging into these. I mean, they're not cheap by any metric anymore, and we're probably going to get a year of kind of just really incredible net income growth as provisions for credit losses slow down, as these banks have just done exceptionally well in the back of what's supposed to be a pretty tumultuous market with tariffs, immigration slowing down, and just the general real estate market here. Regardless, net income was up 25% year over year. These are like tech-like level returns, and that's why these stocks can demand a 16 PE and basically be paying one of the historically lowest dividends in their entire history. And I said it's so peculiar to go from a time where these banks were paying historically the highest yields we've ever seen to now historically the lowest yields in pretty much some of these companies' entire history of being publicly traded. But taking a look here at the actual dividend increase itself, today we declared a quarterly dividend of $1.64 per share, reflecting an increase of 10 cents or 6%. That is not like the craziest growth out of Royal Bank. I mean, if we look at the last decade of dividends here from 75 cents to $1.55, they've definitely done a reasonable job increasing it. But from a dividend growth rate, typically they're doing about 7% a year over 5 years. Like, this seems like a slowing down. If anything, I thought they would be increasing the dividend a little bit more aggressively than that, but something tells me over time there's potential for more aggressive dividend increases because the payout ratios, guys, are just excessively low. Even at these high values, look at the dividend payout ratio. It's 41%. I mean, again, the payout ratio, if you went back this time last year, was almost 50%. And if you went even a little bit further before, it was well over 50, right? Like, typically it trades around 50, 60. But now we're living in a new period where I imagine Royal Bank's going to be like, you know what? Let's just give it back to shareholders. Let's just, keep increasing the dividends. Regardless, what's going on with provisions for credit losses, which is basically the bank having to put money aside in case they get further defaults on their mortgage loans and whatnot. But with interest rates coming down, there's a lot more safety and security in some of these mortgage renewals, and it has leveled off. I think if you just take a look at the year end here, it gives a little bit more of a clear picture. We're talking about $4.3 billion in provisions for credit losses versus $3.2 billion through 2024. But look at the revenue growth from $57 billion to $66, just insane. But what's even more incredible is the net income growth from $16.2 billion to $20 billion. My guys, are you kidding me? I mean, that's insane. And look at the total assets here, $2.3 trillion in assets under management versus 2.17 this time last year. Yeah, I mean, Royal Bank, there's a reason it's the largest company in Canada, guys. I mean, these numbers are very hard to compete with, and it's surprising that banks have just performed so well through this period. Now, also, we've had National Bank posts, and the stock actually went down, which was a bit of a surprise to me because their earnings were also exceptional. Again, these stocks aren't trading at like historically cheap values. So, I mean, they're priced into a major extent, like I mentioned. But, I mean, look at the revenue growth here, guys. $3.44 billion versus $2.9 billion in 2024. I mean, the 9-month end is exceptional here, 22% change in revenue growth. They are only really seeing about an 11% change in the earnings, but they still beat analyst expectations, which is great to see. They did increase the dividend as well, $1.18 from $1.10, 7% increase here. Again, guys, so we should slowly over time hopefully start seeing some increases in the dividends from our favorite ETF, of course, being VDI. We all know it, ticker VDY. If you're an HBNK lover and you're buying into the equal weight bank ETFs, it's nice to see it actually trading down. There's nothing more like seeing than earnings going up and stock prices coming down. That's like the dream scenario that I always like hope for on earnings season. You just want to see some bit of news that's a little less immaterial, like with Meta as an example. Like, Meta had to pay a one-time tax expense and it totally tanked their stock, and it was totally immaterial to what was like insanely record record revenue and earnings growth. So when you see this, guys, you should get excited, like, because we want to keep buying. Like, we're not retiring, we're not living off this right now. We just want to keep accumulating. So pray to God that these stock prices come down. Well, the earnings and dividends continue to go up, because I mean that's what we dream for, baby. But let's talk about Telus. This is a stock in the sector that I've been calling a bottom in now. Basically, it's through the midst of 2025, and most of the sector's bottom. Rogers has recovered quite a bit. Bell's on its phase of recovery. Telus looked like it was in its phase of recovery until this recent hiccup where it dropped quite materially because there's been a lot of headlines, mostly not driven by the earnings, just the headlines and analysts claiming that this stock is going to have to cut their dividend. They can't afford it, blah, blah, blah. And the news today wasn't even that material of news. They literally just said that they're going to basically get rid of the discount drip. Apparently, if you reinvested your dividends, they gave you a discount. They'd issue you a new share. So waited for them to raise capital. And they're pausing the dividend growth until shares reflect the growth prospects. So basically, if you take a look, their new framework is including a new multi-year free cash flow growth target. In addition, Telus will systematically step down its discount drip beginning early 2026 and pause its dividend growth until it's going to continue to pay its quarterly dividend level that it recently announced. But if we scroll down a little bit, what we want to understand is they're just basically trying to fix their debt ratios to 3.5 times. But coming from the CEO himself, our confidence in delivering free cash flow growth at a minimum of 10% compounded annual growth rate through 2028 reflects our strong financial momentum. Additionally, we are executing on our clearly defined plan to advance and systematically step down the discount drip beginning Q1 of 2026. Importantly, it is our intention to continue paying the dividend at its current nominal level. We will, however, moderate our dividend growth model of 3 to 8% according to our dividend yield, including pausing our dividend growth until such time as our share price and associated dividend yield better reflect the considerable growth prospects of Telus. These actions will be augmented by a range of opportunities that we are actively pursuing, including strategic partnerships for Telus Health and accelerated monetization of our considerable real estate and copper assets. Collectively, these undertakings reinforce our strong progress on delivering, with our leverage ratios expected to reach approximately 3.3 times by the end of 2026. Now, the problem with these mega caps, these telecom giants, is the debt levels are just they're pretty extreme. Now, I've said if earnings and cash flow continue to recover as they have been, Telus shouldn't have a problem covering their dividend. That's probably why they're just pausing it. I don't foresee a reason why they would need to cut it. But when you look, because again, revenue's been pretty stable, but when you look at that debt, I mean, 58 billion in assets versus 41 billion in liabilities. And this is why I've been hesitant on buying Telus. I still think it's a great company. I still think it's bottoming out. I think if you're in retirement, you can get good exposure to these stocks through a lot of great ETFs like VDY or XCI or XDIV. If you want to buy them individually, take a little bit more risk. I think the dividend will hopefully be sustainable. Again, not financial advice, but the reason I haven't bought Telus is because I would rather fixate on stocks that have much more potential into the future when it comes to things like Google and Meta. And you guys know this. Those balance sheets are world renowned. The company's growth rates are incredibly exceptional. So why would I chase a yield over what I have higher expectations for in return into the future with companies like those tech stocks, right? And that's how I want you to always approach the markets. And I've said this time and time again, guys, you just want exposure to the best possible companies in the world, and you will see the returns reflect that, because dividends and growth, hear me out, are virtually the same thing, guys. It's not that hard to sell some profit here and there. But again, I expect HBank to level off if this is what we're seeing across the board with Bank of Nova Scotia. All these banks posting great earnings, but not growing exceptionally. It's likely we'll see some leveling off into next year. But, this is not the most favorable time to be buying these equal weight bank ETFs because the yields just aren't that extraordinary. I'll still continue to cost average into VDY regardless, just for some of the diversity in the energy plays and hopefully seeing some of the rally in the lower half of the holdings. But now that I know Royal Bank has done fine, Royal Bank making up 15% of the holdings in VDY, I think we can sleep a little more peacefully at night knowing TD is probably going to crush it. And, even if they sell off a little bit, no concerns at all. We're very confident in knowing that, these top two banks here aren't going to destroy the returns of VDY into 2026. But at this point, I'll pass the question off to you. I'd love to know what you guys think about these earnings. Are you buying Telus? You hold the banks? Love to hear about all of it in that comment section below.